Top 4 biggest trading losses in history. Money can be made in the markets, but it can also be lost in ways so big they make history. These are the top 4 biggest trading losses ever recorded, and the lessons they left behind. Let's begin. Number 1. Jérôme Kerviel at Société Générale in 2008. Kerviel was just a mid-level trader, but he managed to secretly place massive bets on European futures markets. To cover his tracks, he created fake trades that made it look like everything was balanced. In reality, he was gambling billions of euros. When the scheme collapsed, Société Générale lost almost 5 billion euros in a matter of days. Kerviel went to prison, and his name became forever linked with one of the greatest scandals in banking. The lesson? Even one rogue trader can destroy a giant institution if controls are weak. Oversight in trading isn't optional. It's survival. Number 2. Howie Hubler at Morgan Stanley in 2008. Hubler was convinced the subprime mortgage market would collapse. He was right, but his strategy was fatally flawed. To hedge his bets, he bought other risky credit swaps he didn't fully understand. When the housing market crashed, his hedge failed spectacularly. The result? A staggering $9 billion loss for Morgan Stanley, one of the biggest trading losses in history. The lesson here is clear. A bad hedge is worse than no hedge at all. If you don't understand the risks you're taking, you're not managing risk, you're multiplying it. Number 3. Amaranth Advisors in 2006. At the height of its power, Amaranth was a massive hedge fund. But one trader, Brian Hunter, staked everything on natural gas futures. He believed prices would rise. Instead, they collapsed. With billions leveraged on a single bet, the fund lost $6.6 billion in a matter of weeks, and Amaranth imploded. The lesson? Leverage is a double-edged sword. It can multiply profits, but it also magnifies losses until they are catastrophic. And finally, number 4. The London whale at JPMorgan Chase in 2012. Bruno Ixel, a trader based in London, built positions in credit derivatives so huge they distorted the market. His trades were supposed to hedge JPMorgan's risk, but they grew so large they became the risk. When the market turned, the bank was forced to admit a $6 billion loss, along with enormous damage to its reputation. The lesson here is simple. No trader and no position should ever be bigger than the system meant to control it. These 4 disasters, Jérôme Kerviel, Howie Hubler, Amaranth Advisors, and the London whale, remind us that markets aren't just about money. They're about discipline, risk management, and knowing when enough is enough. Because in trading, the line between fortune and disaster is razor thin. And that's the story of the top 4 biggest trading losses in history.